In today's video, we're covering some of the top Reddit financial questions specifically focused on personal finance, like how much cash should you have, how much should you save between paydays, and how to pay off debt. So let's get into it. First question, am I sitting on too much cash? Current situation is I have about $13K sitting in my checking accounts. Monthly expenses are anywhere between $1,600 to $1,800. You're making it about $55K base with $20K commission. Currently have $32K in a 401K, $20K in a Roth IRA, and $40K in a taxable brokerage, $8K in crypto. So let's just say your monthly expenses, let's round it up to $2K. So first off, we say 3 to 6 months worth of savings in our emergency savings. So let's say you have 6 months worth of savings. So that's $12K. Right there, if you have $13K in your checking account and you want to put aside 6 months worth of savings in your savings account as emergency savings, you don't really have too much cash because now you have that 1K buffer. Let's say you only want to do 3 months worth. Half of that. You still have quite a big of a buffer. And I wouldn't say that's necessarily too much cash. Now, it depends on the person, but in the end, you want to cover those bases with your emergency savings, your cash buffer. So I would say at least another month's worth of expense in your checking account, which here would be 2K. And then maybe saving for any other short-term savings that you want. Like if you want to buy a home or put down a down payment in the next few years, buy a car, things like that. That's how much cash you should have. If you want more tips like this to grow your wealth, pay off debt, and learn all the financial 101 tools that maybe we weren't all taught in high school and college, hit subscribe and follow along. How should I plan my finances with my first job after college? Now, I think this is an understated question before we even get into the details. No one really teaches you this, right? You just graduate from college, and unless you were a finance or accounting major, or even that, I was an accounting major, I didn't know how to answer this question. Right after college, you get handed these 401k plans and you are expected that you should know what to do. No one teaches you this stuff. But this person basically talks about how they have a 401k plan and that the company matches the 401k. So my first answer to that is definitely contribute to 401k up to at least what your employer will match. That's free money. So let's say your employer matches, 3% up to $6,000, let's say. So you want to make sure that you're putting in at least $6,000 in your 401k throughout the calendar year so that you can get that 6K match. If you put anything less, they won't actually match up to that 6K. And if you put anything more, that's fine. You just won't get the match past that 6K. Some other things to consider here is if you have a student loan, and let's say the rate is anywhere from 5-6% or higher, you should probably focus on paying that down to start as well. Set up an automated payment. Typically, it's usually based on your income, and then you can make sure you take care of that student loan and put it on automation right out of college. And then live on the salary, post-tax and post your student loan payment. Start building up some cash savings. Make sure you have at least 3 months worth of emergency savings set aside, and then maybe another month sitting in your checking account that would cover that month's worth of expenses. Next, you want to start building some credit. Not a lot of people do this right away, but I always suggest as long as you can trust yourself that you're not going to open a credit card and spend too much, make sure you get a credit card started. Just a simple cash back, very simple, no fee credit card is typically best for a lot of younger people. Helps you build credit, you're not paying fees, and you get some cash back while you're spending it as well. So build cash savings, get that employer match, and then build some credit. If you have any extra savings as well that are left over between paychecks, make sure you're putting that away in maybe a Roth or traditional IRA or in a taxable brokerage account as well. You want to take advantage of time, right? Time is the biggest key with long-term investing. So make sure you're putting as much as you can in that investment account really early on. How much to keep in my personal checking account and emergency fund? Here's the background. Just went full-time with my small business, which I predict to bring in approximately $10K per month post-tax. My wife is a teacher and brings in $2,500 a month post-tax. Total expenses each month, net around $7K. How much should I keep in my personal checking account at all times? I hear 1 month expense is the norm. What about emergency fund? Currently I have $28K, which is 4 month expense. This person knows their stuff. They pretty much have it nailed. So you should always keep at least 1 month worth of cash buffer is what I recommend in your checking account. You're doing that. You should then keep in your emergency savings at least 3 months worth of savings set aside, sometimes up to 6. You're keeping 4 months. Nailed that one on the head. If you have any other short-term goals coming up in the next few years, maybe set aside some cash for that as well. That's the only other thing there. You should not keep any of that though in your main checking account. You should typically have another bucket or cash account set aside that's earning a little bit higher interest. All right, credit card debt. Pay off in full or pay off little by little. I have one credit card that has about a 7K balance. I can afford to pull out of savings and pay it off in full. Would that be a wise decision to make? I think a lot of people go through this. I went through this. So 7K balance on a credit card, let's assuming that you're not able to pay it off for a few months, so you're paying interest. Let's assume you're paying 20% interest, which is kind of normal. It sounds crazy, but credit cards charge a lot. And maybe you're paying some late fees as well. How much cash savings do you have? I'll assume that you have enough cash savings that if you were to pull the 7K out of that, you would still have enough for at least your emergency savings and a little bit of cash buffer. Let's say 1 month worth of expenses. And in that case, if you have the cash set aside, where taking 7K out wouldn't put you in a hole, you're absolutely going to want to pay off that credit card debt. Paying off credit card at 20% is a 20% return, risk-free. I don't know anywhere that I'm gonna get a 20% year-to-year return. So you gotta take that all day. So think about debt just in the same way like you do with growing your investment. You can pay off high interest credit card debt at 20%, that's like a 20% return. Now, my answer changes if you do not have the rest of that cash set aside after the credit card payment. Let's say taking out 7K to pay off the credit card would mean you barely have any cash. That might put you right back into the same situation. A few months later, you might be right back in a credit card debt, and then you're paying more interest down the road. So in that case, I'd suggest only take out of your emergency savings what you can live without for the next few months, and you still have enough emergency savings. So it depends on the person, but just use that method right there. I have no credit. How do you even start out? This is a general question that I'll just answer, but without going into details. So starting out with credit is super important. I always recommend doing it, maybe even high school or college, but at least getting some kind of credit to your name. You're gonna need that later on. Trust me, when you wanna buy a car, buy a home, even get your own cell phone plan, you're gonna need credit. So in this case, I would first start with a secured credit card. Assuming that you have no credit to your name, you can apply for a secured credit card, which basically means you put a deposit down, let's say $500, and then your credit card limit is $500. You can't go above it. But that bank or company has that $500 on hold. You can get it back if you want, but it has it on hold so that you can't go over the credit limit, and they know that if you don't pay it, well, they can just use that money to pay it down and shut your credit card down. So in that case, start with a secured credit card, something with no fee, and then build your way from there. As you build up credit card companies will be more willing to approve you for a credit card, especially if that's unsecured. That secured credit card likely can then be turned into an unsecured credit card down the road. There are 5 main factors that make up your credit score. That's payment history, amounts owed, credit history, new credit inquiries, and then types of credit. Payment history makes up 35% of your score because creditors are mainly concerned with one main question, and that is, will this borrower pay us back? If they can run your credit and see a track record of all on-time payments, they're going to feel more confident about extending credit to you. If they see consistent late payments, or even worse, an account that went to collections, for instance, this can be a big red flag. My suggestion is to simply make every single payment on time and in full, so you never have to worry about this factor. And that's 35% of your score right there. Accounts owed makes up another big chunk of your credit score at 30%. Creditors want to know if you're actually going to be able to pay them back, or if you have too many balances and you might be at a breaking point. They factor in the amount that you owe on all of your debts in relation to the amount of available credit that has been extended to you. If you're using a high percentage of the available credit, the creditor then sees this as a red flag. Now, a good rule of thumb here is to keep your total amount owed to a minimum and definitely below 30% of your total credit limit. If your credit limit is, let's say, $10,000 and you end up spending more than $3,000 in a month, you would go above that 30%. And then that actually temporarily hurts your credit score. Whether it's one credit card or all of them, they look at it in whole. Now, the other 3 factors, length of credit history, new credit inquiries, and then types of credit, make up the other 35% of your credit score. Listen, I don't love these because they feel a bit vague and they aren't as clear-cut as the other main factors. For example, if you're young, you obviously have a shorter credit history just simply based on your age. You can't do anything about that, and that's gonna ding you. If you're trying to build credit, you have to apply for new credit, so that can obviously work against you there as well. You also don't have too many options in terms of credit mix or variety. My suggestion is to focus on starting your credit history as early as possible. If you don't have any right now, start today. Don't apply for too many credit cards though, or too many types of different loans in a short amount of time. And then try to establish a good mix as you build up your credit. But you don't want to focus on building that mix first. Just start as soon as you can. Thanks for watching. This is Tony from Wealthfront. If you like these type of videos, let me know in the comments.